All right, so let's dive into diversification.
Okay.
You know how everyone says, don't put all your eggs in one basket?
Right.
That's diversification in a nutshell.
Right.
It's about spreading your investments around.
Yeah.
So you're not overly reliant on any single asset.
Yeah.
But today, we're going beyond the basics.
Yeah.
What gets really interesting is how to diversify effectively, especially if you already have some experience in the market.
Absolutely. It's easy to grasp the basic concept,
Right.
but the real skill is in understanding the nuances and tailoring your approach. It's not a one-size-fits-all solution.
Okay, so let's start with those nuances.
Yeah.
If someone is listening and thinking, well, I already have stocks in a few different companies,
Yeah.
what's the next level of diversification?
Think of it like building a house.
Okay.
You wouldn't use just one type of material, right? You need a strong foundation.
Right.
Sturdy walls, a good roof.
Uh-huh.
It's the same with your portfolio. Stocks are important,
Yeah.
but you want to explore other asset classes.
Okay, so beyond stocks, where should people look?
Think about commodities. Okay.
These are raw materials like oil, gold, or agricultural products. Their prices tend to move differently from stocks,
Okay.
which can be a good hedge against inflation.
That makes sense. Commodities are something you don't always think about, but they're essential to so many industries.
Exactly. Then there's real estate.
Uh-huh.
You don't need to buy a whole building to invest in property.
Right.
Real estate investment trusts, or REITs, allow you to buy shares of companies that own and manage properties.
Got it.
It's a way to diversify into real estate without the hassle of being a landlord.
So you're saying even if someone's comfortable with stocks, adding these other elements can make their portfolio more resilient.
Precisely.
Yeah.
It's about building that financial shock absorber. Now, don't forget the global landscape.
I mean, looking beyond the U.S. market?
Exactly. Emerging markets, while they carry more risk,
Sure.
also have the potential for higher returns. By diversifying geographically, you're tapping into different economies and growth cycles. That's fascinating. So we've got commodities, real estate, global markets. What are some other tools for effective diversification?
Index funds and bond funds are fantastic options, especially for those who prefer a more passive approach.
Wait, remind me, how do index funds work?
An index fund essentially tracks a specific market index, like the S&P 500.
Okay.
Instead of trying to pick individual stocks, you're investing in a basket of companies that represent a particular sector or market.
Okay.
It's a low-cost and relatively hands-off way to diversify.
So it takes some of the guesswork out of picking individual stocks. But you mentioned bond funds, too. How do those fit in?
Bonds are essentially loans that you make to a company or government.
Okay.
Bond funds pull money from many investors to buy a variety of bonds.
Right.
They're generally considered less risky than stocks and can provide a steady income stream.
So to clarify, you're not saying bonds are risk-free, right?
Absolutely not. Every investment carries some level of risk. It's
Yep.
about finding the right balance for your personal risk tolerance and financial goals.
Okay, so we've got a variety of asset classes to consider, but I'm also curious about specific strategies. Like, how do you decide when and how much to invest in each of these areas?
That's where things get really personalized. One popular strategy is dollar cost averaging.
Okay.
It's about investing a fixed amount of money at regular intervals, regardless of market fluctuations.
So instead of trying to time the market, which is notoriously difficult,
Right.
you're consistently investing over time.
Yeah.
Does that help smooth out the volatility?
Exactly. It's a great way to take the emotion out of investing and avoid making impulsive decisions based on market swings.
That makes a lot of sense, especially in today's world where the market can be so unpredictable.
It also promotes discipline and a long-term mindset, which is essential for successful investing. Discipline and patience are key in this game. But remember, diversification isn't a set-it-and-forget-it strategy.
So even with a well-diversified portfolio, you can't just assume everything will take care of itself.
Exactly. You need to stay informed about your investments and the overall market conditions. Think of it like tending a garden. Oh, okay.
You plant the seeds, but you also need to water, weed, and make sure the plants are getting enough sunlight.
That's a great analogy.
Yeah.
So what does tending the garden look like in terms of a portfolio?
It means regularly reviewing your holdings, understanding how different assets are performing, and being prepared to make adjustments as needed.
So how often should someone be reviewing their portfolio? Is it a daily thing, a monthly thing?
It depends on your individual comfort level and the complexity of your portfolio.
Right.
Some people might prefer to check in monthly, while others might do it quarterly or even annually. The key is to find a balance that keeps you informed without getting overwhelmed.
And what are some signs that adjustments might be needed?
If a particular investment is consistently underperforming, or if your risk tolerance or financial goals have changed, it might be time to reevaluate your allocation.
Okay, so staying informed is crucial. But even with the best intentions, people can make mistakes, right? What are some common pitfalls to avoid when it comes to diversification?
One of the biggest mistakes is over-diversification. But isn't diversification always a good thing? How can you have too much of it?
It's like having a team with too many players.
Yeah.
Everyone might be talented, but there's no clear strategy or direction.
So too many investments can actually dilute your returns and make your portfolio harder to manage.
Exactly. It's about finding that sweet spot, a portfolio that's diverse enough to mitigate risk, but not so spread out that it becomes unwieldy.
So how do you find that balance? How do you know if you're over-diversified?
Start by asking yourself, do I truly understand all the investments in my portfolio? If the answer is no, it might be a sign that you've spread yourself too thin. Another question is, are my holdings aligned with my risk tolerance and financial goals? If not, it might be time to streamline and focus on investments that truly support your objectives.
So it's like having a clear vision for your financial future and making sure your investments are working towards that vision.
Exactly. It's about being intentional with your choices and avoiding the trap of chasing every hot new trend or investment idea.
Right. You mentioned fees earlier. How do fees factor into the diversification equation?
Fees can significantly impact your returns over time, so it's crucial to be mindful of them.
Yeah.
Some investments, like index funds, tend to have lower fees, while others, like actively managed mutual funds, can have higher fees.
So when comparing different investment options, fees should definitely be part of the equation.
Absolutely. It's not just about looking at potential returns. You need to consider the net return after fees have been deducted.
That's a great point. It's easy to get caught up in the hype of a particular investment.
Right.
But those fees can really eat into your profits.
Precisely. It's about being a savvy investor and understanding the true cost of your investments.
Speaking of savvy investors, there's this idea that diversification guarantees profits. Is that actually true?
That's a common misconception. Diversification is not a magic bullet. It can help manage risk, but it doesn't eliminate it entirely.
So you're saying even with a diversified portfolio, there's still a chance of losing money?
Of course. The market is inherently unpredictable. Diversification can help cushion the blow during downturns, but it can't guarantee profits. It's about managing expectations and understanding that investing always involves some level of risk.
That's a really important point. You mentioned correlation earlier. Can you explain how that factors into diversification?
Correlation refers to how different assets move in relation to each other. Ideally, you want investments with low or negative correlations.
So if one investment goes down, another might go up. It's like having a safety net.
Exactly. That's the beauty of diversification. By spreading your investments across assets that don't move in perfect sync, you're creating a more balanced and resilient portfolio.
Can you give some examples of assets that tend to have low or negative correlations?
Sure, stocks and bonds often have a low correlation. Gold can also be a good diversifier because its price tends to move independently of the stock market. And as we mentioned earlier, commodities and real estate can offer diversification benefits because they respond differently to economic conditions.
So it's not just about picking different types of assets, but about understanding how those assets interact with each other.
Exactly. It's about creating a portfolio where the different pieces work together to create a more stable and resilient whole. Think of it like a well-balanced team where each player brings unique strengths to the table.
I love that analogy.
Yeah.
So we've talked about different asset classes, strategies, and the importance of staying informed and avoiding pitfalls. Is there anything else we should keep in mind when it comes to diversification?
Yeah, this has been really great. I feel like we've learned so much about diversification.
We've covered a lot, but the key takeaway is that diversification is a personalized journey. It's not about blindly following a formula, but about making informed choices that align with your unique circumstances and goals.
So it's about taking all this information, all these different pieces of the puzzle, and figuring out how they fit together for you.
Exactly. It's about being an active participant in your financial well-being and understanding that diversification is an ongoing process, not a one-time event. So you don't just set it and forget it. You need to be engaged and stay informed and be prepared to make adjustments as needed.
Precisely. And don't be afraid to seek guidance from trusted financial professionals.
Right.
They can provide personalized advice and help you navigate the complexities of the market.
That's a great point. Sometimes it's helpful to have an expert in your corner. Before we wrap up, is there anything else you want to leave our listeners with? Any final thoughts on diversification?
Consider this. If you were building a house, wouldn't you want a strong foundation with a variety of materials?
Oh, yeah.
Diversification is about building that same kind of strength and resilience for your financial future.
Okay.
It's about creating a portfolio that can weather the storms and stand the test of time.
Yeah, the powerful image. It's not just about avoiding risk, but about building something solid and enduring. I love that. Well, I think we've covered it all today, from the basics of diversification to its broader implications for financial well-being. Thanks for joining us on this deep dive.
My pleasure. Remember, knowledge is power, and the more you understand about diversification, the better equipped you'll be to build a brighter financial future.